The COVID-19 outbreak will have a significant negative impact on the economy and businesses at large, especially small to medium-sized businesses. It is for this reason that government has proposed certain tax relief measures aimed at alleviating cash flow problems during this difficult period. The disaster management tax relief bills, which are currently a draft, include relief for businesses in the area of provisional taxes, employees tax, and employment tax incentive. We will now go to each tax relief, starting with employees tax. The qualifying employers for this relief is all employers that were registered with SARS as employers as at 1 March 2020. The other requirements basically is that your gross income must not exceed 50 million during the tax year. The gross income must not include more than 10% of income derived from interest, local and foreign dividends, rental from letting of fixed property, and any remuneration from employer. And most importantly, the employer must be fully tax compliant. The period that are covered in this relief is April, May, June, and July 2020, which means that the first liability that will be covered is for April 2020. The employer can only pay 80% of the employee's tax liability, and the difference is deferred. What is important is that as an employer, you must pay the full 80% of the liability, otherwise you lose the relief. The question would be, what happens to the deferred 20%? This deferred 20% is payable in 6 equal monthly installments starting from August 2020. What is important is that it will not be subject to penalties and interest. It is important to note, if the employer defaults with any of these deferred payments, late payment penalty will be imposed and interest charged. The taxpayer does not lose the tax relief. If you discover later that your declaration was for some reason incorrect and you correct it and it increases, you will be charged penalties and interest on the additional liability for that particular period. It is evident from the above that SARS will not know whether you qualify in terms of your gross income because you haven't submitted your tax return. So the question is, what happens when you submit your tax return? If SARS discovered that you have exceeded the gross income, which is one of the requirements, you will lose all the tax relief and penalties and interest will apply. However, it is important to note that normal rules will apply if you apply for remission of interest and penalties. The next relief is employment tax incentive. The qualifying employers in this regard are all employers registered for PAYE with SARS as at 1 March 2020. One other main important requirement is that the taxpayer must be fully tax compliant, which is the current requirement in the employment and tax space. The periods that are covered are also April, May, June, and July 2020. The first category is the employees that qualify in terms of the current existing rules. The second category is a new category. It's employees with ages 18 to 29 with salary bands of 6,500 or less. These are employees that the same employer has already claimed ETI according to the existing rules for at least 24 months. The government is proposing an additional amount of up to 500 for this category. That category is also new. It's employees with ages 30 to 65. These employees never qualified for ETI because of the age limit, but they still meet the requirement of earning 6,500 and below. Government is also proposing an additional amount of up to 500 rand for the employer in respect of these categories. Any unused ETI for these periods, which is April, May, June, and July, will be paid by SARS on a monthly basis as a refund. The qualifying taxpayers in this regard are all taxpayers conducting trade who has a gross income of 50 million or less for the year of assessment ending during 1 April 2020 to 31 March 2021. The periods covered under provisional tax are as follows. It's the first provisional tax due within the period 1 April 2020 to 30 September 2020, and the second provisional tax period due within the period 1 April 2020 to 31 March 2021. The relief basically is as follows. For the first provisional tax period, the taxpayer is allowed to pay only 15% of the total estimated tax liability instead of 50%. For the second provisional tax period, the taxpayer is allowed to pay only 65% of the total estimated tax liability. The deferred 35% effectively is payable by the third provisional tax period. That, of course, depends on when your year-end finishes. Most importantly, no penalties will be paid or interest payable on the deferred amount. In conclusion, SARS will only determine when you submit your income tax return whether the requirement of the gross income have been met or not. If it turned out that you did not meet the requirement of the gross income, you will lose the relief and interest and penalties will apply. If you lose the relief, depending on the facts and circumstances of each case, a taxpayer can follow normal rules for request of remission of penalties and interest.